We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Justin Huhn, founder and publisher of the Uranium Insider newsletter. Justin, thanks for joining me today. How are you?
It's my pleasure. I'm doing very well. How about yourself, Tom?
Excellent. It's always a pleasure to speak with you and to catch up, particularly as you and I share some common interests here. But I wanted to start by asking you how you see, let's say, the risk to the uranium market right now if we see nuclear weapons exchanged here in this conflict between Israel and Iran, or as that broader net kind of goes out. Obviously, understanding the risks to a particular market are always paramount. We've seen sentiment drastically change within the nuclear market and the whole uranium cycle and thesis change dramatically over particular events. So if we do see nuclear weapons used here, hopefully we don't, but do you see that as being a major risk for the markets?
I mean, I think to market risk in general is probably the most likely market-related outcome of an event such as that. I don't really see the uranium and the nuclear power production markets necessarily linked with nuclear war. So I honestly think something like that happening would be a greater risk to the broader markets, to speak generally, than it would be specifically to the uranium market. Part of the reason I say that is that over the past week, as we've seen tensions and actual hot warfare escalate between Israel and Iran, we aren't really seeing, let's say, the equities pricing in an eventuality of that, or if that were to happen, that we would see necessarily uranium specific selling. Mm-hmm. So I don't expect that it would affect the physical market whatsoever. But that's, of course, this is all speculation, and hopefully that doesn't happen. And hopefully if it did happen, it wouldn't escalate into a much broader, much more intensified nuclear war situation, because then I think we've got problems that are far beyond markets. So it's not really, as far as investments in the space are concerned, I'm not really concerned about that. Mm-hmm. The concerns really are much more broad. It does look like Israel has been attacking their nuclear facilities. That's not their nuclear power plants, but their enrichment facilities. Of course, the concern being Iran enriching beyond what they are technically allowed to from the various organizations around the world, keeping tabs and keeping limitations on the enrichment levels. So, but having the capability to enrich to 4 to 5%, it's not a stretch to continue that process. The same process that got you there could potentially, take you up to warhead grade enrichment, and then, they're in launching range. And there's obviously many countries concerned about the Iranians getting nuclear weapons. So obviously they've been going after that. There's low level radiation that's very localized from, destroying these facilities, is my understanding. So not really all that concerned of how that will affect the physical uranium market, the uranium equities. I don't really think there's a connection between those markets, besides the fact that enriching uranium, you can enrich to higher levels theoretically, and the operation of a nuclear power plant that's powered by uranium, you have plutonium as a byproduct of that. Plutonium is utilized in nuclear weapons as well. So having a nuclear program potentially gives you that option, but it's complicated and not, in my estimation, not directly correlated.
Mm-hmm. Justin, I think it's worth maybe kind of going over this idea of enrichment and what that means for those that might not understand it. The grade and percentages that are needed for, let's say, nuclear fuel rods are drastically different than what you would want for, let's say, weapons grade uranium or plutonium as a byproduct. Can you walk us through a little bit of that?
Yeah, of course. So uranium, when it's mined out of the ground, is in the form of, it goes through mild processing and then is in the form of what's known as yellow cake. That's triuranium octoxide, U3O8. And that's the yellow cake, that's the dry powder, mildly radioactive. That then goes through a process of conversion where it's converted into uranium hexafluoride or UF6. And in the industry knows that as natural uranium, even though it's gone through at least two processes at that point. They call it natural uranium. Natural uranium UF6 has about 0.7% U-235, and that is the fissile, the radioactive isotope of uranium, is the uranium-235 isotope. So it's primarily two isotopes. There's the third, but the two isotopes, U-235, U-238. The U-235 is what you want as far as radioactivity for production of heat and therefore electricity. And enriching that to a higher percentage of U-235 is the whole point of enrichment. Light water reactors and boiling water reactors, which make up 90% of the world's reactor fleet, require a higher enriched uranium than what is naturally occurring. CANDU reactors, heavy water reactors, actually operate on natural uranium fuel, so they don't require enrichment. And that's a whole different technology that I don't completely understand. But so the enrichment goes from 0.7% up to about 4 to 5% is on average for what's known as low enriched uranium, or LEU. It's also known as EUP, enriched uranium product. So when you see EUP or LEU, we're talking essentially about the same thing, 4 to 5% enrichment. The way that it's done is that UF6 gas, the natural uranium, is spun at very high speeds in a centrifuge. And the very, very tiny difference in mass between 235 and 238 ends up separating those atoms to the point where you can actually have more of the U-235 as a percentage of the whole. And the tails are what is left over from that process that are higher in U-238 and lower U-235. And so that process taking you up to 4 to 5% is low enriched uranium. We also have, we're starting to see certain enrichment facilities and certain nuclear operators operating light water or boiling water reactors actually go for slightly higher enrichment, like pushing 5 to 6% for longer periods between refueling outages for a little bit more efficiency. And we're slowly moving in that direction. And then you get up into what is known as high assay low enriched uranium. Below 20% enrichment is still considered low enriched uranium, but HALEU, high assay low enriched uranium, is up to 19.9% U-235. And that is oftentimes the fuel that is proposed to be used in advanced reactor design. So these are high temperature gas reactors, sodium cooled reactors, things like that. They are oftentimes operating on HALEU. So HALEU is going from 4.5%, 5% up to potentially up to almost 20%. Weapons grade uranium is typically over 90% U-235. So it's a much longer, much more intensive process, but essentially the same process. It's just continuous separation of those isotopes until you have almost pure U-235, extremely radioactive, extremely fissile. And that's what is utilized oftentimes along with plutonium in nuclear warheads.
Mm-hmm. And then where does, that's what I was going to ask, is where does plutonium fit into that as well? Because you mentioned that at the beginning.
Plutonium is also highly, highly radioactive and unstable, and it's produced essentially. It's not a naturally occurring element. It's produced in that fission process where the U-235 atoms in a reactor core react in that environment, create heat, and plutonium is one of the byproducts that has to be. And typically it's stored with the spent fuel in the casks, and we're talking about commercial operations of nuclear reactors. So you have to go through a process of extracting plutonium in order to utilize it in weapons. So sometimes they're plutonium based, sometimes they're weapons grade U-235, 90% enrichment grade uranium.
Mm-hmm. I appreciate that explanation, Justin, for those that don't necessarily understand the differences and the different grades there, and really the time and energy involved into that. But the other part of what you kind of the explanation that you gave at the beginning is this real disconnect between what many see as the risk right now and then what the markets are actually pricing in. So does the markets not really reacting in a way that we would expect war breaking out in the world, especially in such a, let's say, sensitive area. Does that tell us more about the story, do you think?
I don't know. That's, I was just speaking with a friend of mine before we got on this call, and I was sharing a quote from my partner Rick at Uranium Insider. He's a former hedge fund manager, multiple decades metals and mining space. His former partner had a quote that he shared with me, which is sometimes even if you had tomorrow's newspaper today, you still wouldn't make money in the markets. And so you rewind 1 week. Today, last week, 1 week ago, we saw the instigation of this hot conflict, right? We saw Israel send missiles into Iran. Iran followed suit. Then all of this action over the weekend intensifying. Then Monday morning, the markets open. Gold is down. Oil is down. The S&P is up. And who would have thought that would be the outcome with intensifying hot war over the weekend? Absolutely zero people. And oftentimes the markets just don't do what you expect them to do in the short term. I don't know if the market is pricing in that this is going to go away soon, which hopefully it will, that this will end soon. That's, of course, what we're hoping from a humanitarian perspective. As far as how the uranium market would react to a nuclear conflict, it's entirely possible that there's a knee-jerk reaction in the markets, even though these markets are not correlated. Whether or not that would be long-lasting, I strongly doubt it, mostly because the underlying fundamentals of the actual fuel cycle and the physical uranium market are going to continue to push the price higher. So, and honestly, and this is not something I would ever hope for, but nuclear conflict or potential nuclear conflict in the nuclear arms race, let's say, if that were to intensify, that is demand for uranium also. So, it's not something we're pricing in. It's not something we're modeling for. It's something we absolutely hope does not happen. But we do know one example of this is China has the biggest inventories on the planet of uranium, more than 600 million pounds. Most of that is across the fuel cycle for peaceful uses of nuclear energy production in country. China doesn't have very much uranium. They're building out conversion and enrichment and fabrication, but they have to buy uranium. They have to buy projects. They have to build mines to get that uranium. We do know that number includes military stockpiles, which have been growing in China. So China bolstering their military stockpiles of uranium has led to some of their buying. So that is an element of this market, whether or not we acknowledge it, whether or not we like it or not. Increasing, nuclear armaments is a pull on uranium demand. So I don't know how the market would react. I have no crystal ball, but there's just some random thoughts about it.
Yeah, I think it's a very difficult situation to kind of analyze and really find reasons for, but I just like to get people's thoughts on, things that we might not be considering, right? And I think it's always important to kind of back out and be looking at this bigger picture here, Justin. So, looking out over this, let's say, coming decade, there's a lot of assumptions about the amount of supply that can come online to meet the amount of demand. So is that supply demand mismatch still present and or even growing from what we've seen for the last, let's say, 5 years?
It's definitely still there. According to our models, we see almost 200 million pounds of uranium demand from the global nuclear reactor fleet in 2025. We should see about 160 to 165 million mined out of the ground this year. So structurally, between actual mine supply and demand, we're looking at 35-ish million pounds short. Of course, there's some secondary supply, which comes from enrichment underfeeding. That is about a third of what it was around 3 years ago. So that has dwindled a lot. There is significantly less inventory overhang, inventory sales as secondary supply into the market, even though it isn't real secondary supply because that supply was counted the first time it came out of the ground. And then once it's in inventory and it's sold back into the market, some of the price forecasters, nuclear analysts will actually count that as secondary supply, even though it's double counting. But I digress. Some secondary supply will be there. So the actual structural shortfall isn't 35 million pounds. It's less than that. But we also have secondary demand, as we're about to see, and as we've already seen a little bit. Sprott just raised $200 million in a bought deal on Monday. They're about to come into the market buying uranium. So there's secondary demand, not just from financial players, but also the potential of inventory restocking. Anytime a utility is buying, let's say, anything above and beyond their expected burn up rate, that is bolstering and restocking their inventories. That's technically secondary demand. And then, of course, military stockpiling. Like I said, we don't model for this. It's not in our demand model, but we do understand that the United States, for example, their stockpiles of uranium for military purposes are on the lower side. And we actually do expect them to do some buying before the end of the decade and potentially into the 2030s of uranium for military stockpiles, not only for warheads, but also for the nuclear navy, et cetera. Those stockpiles of uranium, decommissioned warheads, high enriched uranium, Russian, US, they're a fraction of what they were back in the 70s and 80s. So they've essentially dwindled since that point. There really hasn't been military stockpiling of uranium with the exception of China in recent decades. So that's further potential secondary demand. And it's hard to model that. We model essentially for about 10 million pounds of secondary demand, and that could be highly conservative some years. That could be a little bit more in other years. This year, it's probably going to end up being on the conservative side, depending on what Sprott's going to do and who else follows suit, not only from financial demand, but inventory restocking demand as well. So, and that's just a snapshot of this year. Supply is responding. It's responding slowly. Most of that supply response has had some element of problems, been few exceptions. Energy Fuels is doing pretty well with producing uranium this year so far. Looks like they're going to produce about 1 million pounds coming out of White Mesa, which is way more than they produced in recent years, which has been essentially nothing. Turning that uranium circuit back on. Boss has done well with Honeymoon. Pretty much everybody else has had problems in their brownfield restarts or greenfield development. And we see the market getting closer to being balanced over let's say the next 3 or 4 years, if what we're modeling on the supply side does actually come to fruition, and we don't see further upside demand shocks. But really, the problem exists in the later decade, early 2030s and beyond, because a lot of projects start to come offline. Legacy mines that are producing now will start to diminish in their production and eventually come offline entirely. Rossing is going to be offline in the next 5 or so years. Cigar Lake looks like they're going to be developing phase 2, but even that is going to be completely done in the 2030s. Husab is going to be done by the late 2030s. Langer Heinrich by the mid 2030s. Then we get into the projects in Kazakhstan, and half of those projects are basically done by the mid 2030s, and some of them will be done in the next 3 to 4 years. And the ones that are done in the mid 2030s decline in production before that eventual closure date. So a lot of legacy production is coming offline, and the only elements that could even bring us even remotely close to a market balancing are big projects that have yet to be built. And that's really where this linchpin is, Tom. Like, we're talking about the arrows of the world, right? This project where the feasibility study that NextGen has put out is showing 29 million pounds of production for the first 5 years. Most who analyze the space don't believe that this project will be producing that much on an annual basis. And most believe that this feasibility study and the numbers put out were basically there to try to kind of blow up the NAV on the front end to make the project look extremely valuable, which it is, potentially to attract a suitor. I'm not speculating on that necessarily, but it's a very, very large, undeveloped, extremely high grade project that could be a decades-long kind of Saudi Arabia of uranium, especially with this project, the exploration project, the Pattison Corridor East, that is hitting amazing intercepts with the drill bit. And I think they've got almost potentially another arrow on their hands in the exploration side, and the market doesn't care, which I love. Wink, wink, hint, hint. So this big project, they signed contracts in December for first delivery of uranium in 2029. They have already revised that timeline since that point, 7 months ago. Mm-hmm. So their timeline for construction since December has gone from 42 months to 48 months. And they've also had clarity from the CNSC that the review process will have 2 essentially review events. One will be in a couple of months. The final one will be in February of next year. So if everything goes perfect for the company, they'll be permitted, let's say late Q2 of next year. Then if everything goes perfect and they develop this project 48 months from them, that's the middle of 2030, first cake in a can 2031. Best case scenario. Best case scenario is 2031 from Arrow. And we think not just this project, but basically every other greenfield project, whether that's the Budanovskoye joint venture, which is having problems in Kazakhstan, mine number 6 in Russia, which has been 2 years away from production for the last 8 years. There's development project in Brazil that also has been near production for the last 7 years and still nothing. Greenfield, like Dasa in Niger, they're developing the mine under really tough circumstances, but that's obviously hit many roadblocks. Cameco is saying they're not going to expand McArthur River until the utilities show up and sign the contracts that they want. All of these elements of greenfield production are likely to have hiccups or delays in scheduling, cost overruns. And the most important point of all of this is to say there is an insufficient buffer of inventories and secondary supply in the uranium market right now. And the pounds that are going to fulfill the utilities demand late decade into the 2030s quite literally have to come out of the ground. And anything that goes wrong with any of these projects is going to have reverberations across the physical market. That's how we're seeing it right now. Supply expansion is imperative. And this is the first time, to my understanding now, I've only been following this market since 2016, but we talk to people that have been in this market since the 70s. And they say that we've never had a period of time ever in the history of the uranium market for commercial nuclear where there's basically no overhanging inventories and supply buffer here. And the supply that is going to feed the utilities literally is going to have to come out of the ground, but from projects that haven't put a shovel in the ground yet. This is new territory, and the likelihood of everything happening on time, on budget is basically zero.
Well, Justin, as we're talking about that, the idea of everything happening on time, on budget being basically zero, it makes me wonder if even if we took all of the regulatory hurdles out of the way and fast tracked approval of these types of projects, if that would have any effect or ability to move any of those timelines forward by any meaningful amount.
It wouldn't hurt things, that's for sure. Regulatory approvals have slowed things down a little bit in Canada, let's say, for some of these larger projects, Arrow being one of them. Denison's Phoenix is another. Back in 2018, Denison expected Phoenix to be in production by 24, 25. Now that's looking like 28, probably best case scenario. They're still waiting for permits on that. But really, the projects that are potentially going to be producing in the next 5 to 7 years are already, if not permitted, close to being permitted. And so permitting risk and going through the bureaucratic hurdles of getting a project permitted pre-construction isn't really slowing anything else down right now. So most importantly, what is slowing down the development of projects, especially the marginal projects that are higher cost, is literally the price of uranium in conjunction with utilities activity. So it's one thing for uranium to go from 75 spot, 80 term, which is where we're at right now, to let's say 80 or 90 spot, 90 to 100 term. If we get to that point within a year or so, that doesn't mean that projects like Bannerman, Zitango, Deep Yellow's Tumas, a bunch of stuff in the United States, some of these bigger development projects that will take 10 years, deep deposits in the Athabasca, price alone is not enough of an incentive to spend $500 million to $1 billion in 10 years of your life building a mine, only the market by the time you're producing potentially not be where you need it to be for the mine to be profitable. You have to have utilities stepping up to the plate, signing contracts at the terms that you require for your project. So these marginal projects aren't getting built just because the price arrives at a certain point, at an incentive price. And we think that incentive price for the marginal stuff of the world is north of $100 a pound here. We have to get there, and you have to see utilities buying in much more higher volumes in the term market. Fortunately, the move to that level should involve utilities, unless, of course, we see like what we just saw with Canacord and a bought deal with Sprott happen another 5 times in the next 12 to 18 months, which it could. Then we're going to see the financials push the price up and the utilities are going to get into a major squeeze and they're going to drive it even higher. So we have to see those pricing elements. We have to see utilities signing contracts in higher volume. When we do, then we'll see those development projects that are marginal start to actually build those projects. And then a few more years down the road, those pounds will be coming out of the ground. But it's always a tricky market to model. It's a tricky market to predict because it exists in the future. The utilities are covered for the next 12 to 24 months, almost entirely across the board because they have to be. The fuel cycle takes 2 to 2.5 years right now. You have to be covered in the fuel cycle for the next couple of years. And most of them are. It's 29 and 30 and 31 and 32 when they're not covered. In fact, by 2031, most utilities globally are uncovered for uranium. And we've got a 400 million pound supply deficit cumulative over the next 10 years. And the period of time where utilities are most uncovered is the period of time where the deficit really starts to expand. And we're talking about, 2031, 2, 3, 4. And that's the period that they're going to have to start contracting for in the next 12 to 18 months. So really, what's happening right now is the future. And the future, when we go out to 2030, you're betting on projects that haven't even touched the ground yet. And that's a problem. Not for me. It's a problem for the utilities.
Justin, let's talk through the significance of that Sprott deal. You mentioned that they raised $200 million either through or to do with Canacord. Why is that such a big deal at this point?
So about a month ago, almost 5 weeks ago at this point, Sprott did a private placement for $25.5 million. This was done off market. This was done at a slight premium to the market. So that is to say the trust was trading, I think, at about a 3 or 4% discount when the deal went through. And the institutions that participated in this placement were willing to pay that premium, knowing that the money going into that vehicle, the units that they were buying off market, even though they paid a slight premium, they knew that cash was going to Sprott. Whereas if they went in and bought 25 million, in the open market at a 3% discount, they would have gotten a slightly better entry in terms of that price of those units. But none of that money would have gone to Sprott because they would have been trading at a slight discount at the time. So that raise enabled them to avoid selling pounds into the spot market to raise cash. They were down to, I think, $6 million in their balance sheet. And they were preparing essentially to either do some location swaps, although that's largely off the table. 2-3 months ago, location swaps, there was the $1.50 to $2 spread between CalMer9 and Cameco, and now it's only like 50 cents. So they were going to swap some material and then arbitrage that difference. That's kind of off the table. So they were basically preparing to sell 50 or 100,000 pounds in the spot market. Not a big deal, but that narrative was out there and it was adding to the poor sentiment. But just they can't get to a premium. They're running out of cash. They're going to have to sell. And if we're hearing from contacts of ours that manage uranium-focused hedge funds, or like we talk to these guys, these pod shops all the time in New York City, their best idea is short uranium. And if you ask them why, they've done 4 minutes of due diligence. You ask them why, they say because SPUT's going to have to sell. So that placement erased the need for them to sell, and it killed that narrative. Importantly, it established a precedent that the market ignored. And this was a head scratcher for me because I saw this happen. I was like, whoa, this is new territory. There's institutions willing to pay a slight premium to go off market and put money right in SPUT's pocket. Maybe this will happen again. Market didn't think so. I did. I didn't know it would happen this quickly or in this size, but here we are. Sunday night, news came out, this was 4 days ago, that they had done a $100 million bought deal private placement with Canacord. Monday morning, the market's open, a couple hours into the market, the upsized it to 200 million. Single entity, Canacord. So since Sprott took over Uranium Participation Corporation in 2021, and since they activated the ATM in August of 2021, it's always been an understanding for investors, let's say, that somebody with very deep pockets could load up on equities, and then pile into SPUT. And that would ideally push them to a premium. They can trigger the ATM, start issuing units into the open market, raise some cash, buy uranium. That pushes the uranium price higher and it lifts the equities. And it happened August through October of 21, March, April of 22, and a couple of other times since then. But basically, they've traded almost at a persistent discount to NAV, and they haven't been able to really raise a lot of cash through that mechanism since those big funds stopped pouring money into the vehicle. But it's always been looming. Somebody can do this at any time. And I have not understood why it hasn't happened sooner and why now. So Canacord, they've been covering the uranium sector forever. Katie LaChapelle from Canacord has a brilliant supply and demand model. She covers the sector very, very well. Highly recommend anybody check out her work. They know uranium. Okay. So now, guaranteed, they're long a bunch of equities in the space. Now they're piling 200 mil into SPUT off market. And now SPUT's going to come in and buy uranium. This deal is supposed to close potentially tomorrow. We're speaking on Thursday, the 19th. So the 20th, it's supposed to close by tomorrow. Will they be cashed up that day or maybe early part of next week? I'm not sure. Probably we're looking at Monday, Tuesday. How they plan to buy uranium with this 200 million, we don't know yet. And the company can't talk until this deal is done. So we're waiting for that to see what they do. I don't think they're going to come in and demand 2 million pounds for July settlement because it doesn't exist. If they do that, the price is going to pop $10+ in a day. I don't think that's how they're going to do it, but I do think the demand that's going to come from SPUT is going to move the market. We've already seen the traders push the price up $5 in expectation of SPUT's buying, which they didn't do yet this week, even with the 30 million they have in cash right now. So this is all to say that I think this is new territory. The fact that, to quote Nick Lawson from Ocean Wall, the apex predators have arrived. They're looking at the space differently. And this is a major precedent that the utilities of the world should be watching and should be concerned about. Because 200 million, it's a lot of money for you and me. It's not a lot of money for the money managers of the world that know that this is a small market that they can push around as they wish. How much more can be done like this? It's hard to say, but what is easy to say is this is a precedent that has been established, and the financial buying could absolutely snowball from here. And the whole market, I'm telling you, Tom, everybody was expecting after this big move, URA has been up 10 weeks in a row. After this big move, if the spot price stagnates or even starts to drop, which it started to last week, we're probably going to see a quiet summer. The utilities are going to be off in Saint-Tropez, doing not the utilities, the fuel buyers, right? They're taking vacations to paraphrase, taking vacations, slow summer. Then we have WNA in September, fuel conferences in the fall. A lot of utilities have new budgets, October 1. That's the season where they come back to the table and get this work done. Well, this just really switched that up. I think the quiet summer is probably not going to happen now with the amount of buying that Sprott has ahead of them. The big question here is what sort of momentum could come from the buying that they're going to be doing? Will utilities engage more quickly in their procurement strategies because of this momentum? That remains to be seen. We'll see. We'll start to see this next week, I'm sure. How long SPUT drags out that buying, how drastically that's going to push the price, and who else is going to come to the table to participate in this price move. Those all remain to be seen, but very exciting to see that sentiment shift. And everybody is ready for the sector to consolidate this huge move that we just had. And SPUT just said, hold my beer. So, well, this should be very interesting in the coming weeks for sure.
Mm-hmm. Well, how do you think that, or how has the, let's say, role of SPUT changed over time? Like, I think when you and I first started discussing this vehicle that Sprott has designed and built over the last couple of years here, because it's a fairly new vehicle. Initially, I think they were not going to be selling pounds back into the market. So how has this changed, and how does that mechanism work now?
Sure. Their mandate remains to buy and hold uranium. and to give investors exposure to the physical commodity. There's a lot of criticism of the vehicle that because they are never going to sell that uranium, that it has no value, whatever. They've established their place in this market, and it's liquid, it's pure exposure to the commodity, it works, they're doing what they said they would do. As far as the uranium coming out of the trust, they are allowed to sell uranium. Their mandate is to not sell it, and they will not be trading and selling uranium to utilities, signing contracts, loaning out material. Believe me, they've been requested to loan material and they haven't done it because they know that the shareholders do not want that. Selling 50 or 100,000 pounds to keep the lights on, if they have to do that, that really is not a big deal at all. That could happen, and it was about to happen. It's not going to happen now, but that could happen in the future. Okay, whatever. Could they technically be bought out? Yes. Somebody or a consortium of utilities or a tech company, somebody with an enormous amount of money, because right now I think they're at a 5 billion AUM, would have to make an offer sufficient that 2/3 of the shareholders would vote yes. Mm-hmm. So not 2/3 of those that choose to vote say yes. 2/3 of the total shareholders of the trust have to vote yes.
Wow.
That's a big undertaking. That's one of the reasons why they actually didn't ever get it over the line with getting a New York NYSE listing, is some element of that had to have shareholder approval, and it would have been a mess for them to get that done. It would have taken a year. It would have taken an enormous amount of money and marketing. So you can only imagine, let's just say you're a shareholder, a unit holder of SPUT. SPUT is sitting here, what is it right now? Let me look at my chart for a second. On the Canadian exchange, 24.58 on the Canadian exchange. What sort of premium would you accept in a buyout offer for you to vote yes, knowing that 65 million pounds of uranium would then go to the buyer? Mm-hmm. It would have to be a very, very large premium. And ideally, and that would probably be your only position, right? Because if you hold other uranium equities and the buyout offer is made right now, you're probably going to vote no on it unless it's a massive, massive premium. So we're talking right now at a 5 billion AUM, we're talking a premium, what, 8, 9, 10 billion of an offer? So who's going to make that kind of offer is my question to you. The other question is, what does the environment look like for uranium, for the fuel cycle, for the actual physical market, for somebody to actually do that, to need that much uranium so badly that they're going to pay up for it and offer a premium sufficient that 2/3 of the total unit holders vote yes? So my point with this is, technically, can this happen? Yes, it can. What are the conditions that are going to lead to this happening? They're conditions that are going to make me very, very happy as an investor in this space. So I don't know if or when that happens, but between now and then, we're going to see an enormous run and much, much higher uranium prices before that ever would happen. Most likely, the pounds from Yellowcake would get bought out because they hold much less uranium. It's a much cheaper ask, let's say. They also have traded at a more persistent discount to NAV, so it might require less of a premium in an offer. That could happen. I think they hold 18 million pounds of uranium. So that's something, but we're still not there yet, and that's not on the table yet. So we'll see. The conditions for something like that happening would be very, very, very positive for current uranium investors. Let's just say that.
Well, it seems like there's positives kind of all around the sector and sentiment. You know, you and I have, again, talked before about sentiment within the industry, sentiment around the regulatory side of the industry also changing. And we've seen these positive developments, both from the US side, trying to incentivize more uranium production. But we've also seen now that the World Bank has now lifted restrictions on financing nuclear energy projects, right?
They have, and that's a big shift. So officially, the World Bank's policy to not finance nuclear projects has been since 2013, but they haven't actually financed a nuclear project since the 50s. So this is a very, very big shift. And this is just in line with other shifts that we've seen recently, which is Germany essentially capitulating to France and saying that they will accept nuclear as green. Doesn't mean they're going to restart the reactors, but it continues to kind of step in that direction as a possibility.
Mhm.
But it does mean that the EU as a whole, I suppose, with the exception of Austria and still Spain is still sticking to their guns with the phase out policy. There's a lot of pressure to reverse that right now, coming from especially the nuclear utilities in Spain. But hard to say. That's very politically, ideologically driven, which we all know can be very stubborn in terms of policy changes. They happen slowly and with a lot of pain, usually not just flipping on a dime. So not holding my breath for Spain, but it is moving in a good direction. So is Germany. Germany flipped. The UK just basically said that they're going to allow the funding of, I think it was 14 billion euros or 14 billion pounds for the building of Sizewell C. This is a large French reactor. It's 2 reactors, actually, more than 3 gigawatts. So that's in process. The sentiment shifts. So the sentiment for nuclear has been steadily moving in a very positive direction for years. It's been moving in that direction without exception. There really hasn't been any strong reversals negatively. Taiwan shut down a reactor about 3 weeks ago. They're already talking about restarting it. South Korea, they've got a presidential candidate leader that is not super pro-nuclear, so they could slow down their domestic builds, but their exports would probably remain pretty significant. Koreans are fantastic nuclear builders, as we've seen in the UAE. But nuclear policy-wise, acceptance of nuclear, sentiment for nuclear, moving up and to the right. The equities go through crazy volatility swings. I was trying to pull up in the background a minute ago. I took a screenshot that was a representation of sentiment. This was like late March, a couple of weeks before the actual bottom. And I had reposted on X. I think it was an article having to do with the Germans looking at potentially something having to do with German sentiment around nuclear, and it was positive. I said, "This is good to see." And the first comment was "F you." And like basically that's how it was on social media. It was just terrible, terrible sentiment. The swings are so violent. And gosh, at moments like this, after 10 weeks in a row of URA being up, I go back to just 2-3 short months ago and think about the people that capitulated. And this is just how markets are. It'll never be another way, and you can't avoid it. As much as you can say until you're blue in the face that the fundamentals are still strong and this will eventually turn, and this is a moment to weather, or even if you have strong conviction, put money to work, which I personally did. It's still going to shake a lot of people out. And I'm telling you, there is a trail of bodies behind this investment right now. And a lot of those people are either so hurt that they can't even look at the screens right now, or they're buying back in and chasing it back because they did believe and still do believe that this is a structural bull market for the commodity. And it is. And that this sector is going to go on a very, very strong run. It just couldn't take the pain. And I get it. And I'm not taking a victory lap at all. I'm just saying those signals for me are very easy to read because of our membership, because of social media presence. And our members have been very, very strong and very supportive and very thankful. It's largely the social media presence that gets kind of nasty, but seeing that is a huge signal, and it aids in my conviction to put money to work. So yeah, I got pretty aggressive back in early April in terms of leveraged longs, and that's paid off extremely, extremely well. But the sentiment swings are going to shake people out. That's just how it is. As far as the nuclear sentiment, I mean, in my wildest dreams 5 years ago, I wouldn't have been seeing some of the stuff we're seeing right now. It's truly phenomenal, and the runway for this is very, very long.
Mm-hmm. Well, it's interesting to think about, let's say, the behavior of the last bull market here. And it seems that this is I would say, a more mature market this time, where it's less exuberant, less dangerous. But I think there's, let's say, a hangover from the last bear and bull cycle, where people don't want to get caught with their fingers in the door still, right? And so they're ready to jump out. But after seeing, as you said, 10 weeks of higher closes, that's extremely, extremely positive for the sector.
It's always tricky because investors, and myself included in that, are always looking at the past to try to get an idea of what to expect in the future. And I think that's utterly incorrect to do right now for this space, because it's a totally different market. It's a much, like to your point, a more mature market. It's a much more structurally supported bull market. So the previous market, you came off of extreme lows of like $8 a pound or something like that in 2001 or two. And during a period of time where we had megatons and megawatts, 20 million pounds a year coming from Russian downblending into the US market, enrichment underfeeding, the Kazakhs ramping. I mean, from 2004 to 2010, they went from barely producing anything at all to producing, 50 million pounds a year, 45 by that point. Huge ramping in production on part of the Kazakhs, a ton of secondary supply, underfeeding, megatons and megawatts. It was all there. And what happened was a slight recovery in the price led to financial speculation, hedge funds buying a ton of uranium, UPC being established, financial driven price rises, and a couple of exogenous events. There was a tornado in Namibia. There was a Cigar Lake flood twice. These things affected the price, and it was a much faster, crazy moonshot that happened right before the GFC, and then it was over. And this is just totally different. It's totally different. We have a sector that is growing at a much faster pace than the sector was growing back then. The other element back then was the Chinese. The Chinese had ambitions of growing nuclear at a fast pace, and they were buying and signing a lot of large contracts like they have been in the last few years. So that's a similarity to the previous market. The difference there is that Chinese are actually building to the pace that they're saying they were going to do. So back then it was like, we're going to be growing our nuclear program, we're buying uranium to feed that. Now it's the last 3 years, we've actually seen 10 construction approvals per year. And the following year to 18 months from those approvals, construction actually has started on those reactors that were approved. They are actually right now on pace to hit that previous target of 150 gigawatts by 2035. That is different than the previous market. And we also have a structurally undersupplied market that didn't exist in the previous bull market. So this is a much, much more fundamentally, structurally supported bull market for the commodity that we don't know when this is going to end. And looking out into the future with our modeling, we can best case scenario it with potential supply projects that haven't been built yet. And that gives us some idea of maybe what the market will look like. But that's even with best case scenario, we have an enormous deficit that starts, 2032 or 3. We have a small deficit between now and then, best case scenario on the supply side. Any of these projects get disrupted, I don't really know where the uranium is going to come from, which could be a problem for new builds going out into the next decade. But as of right now, the pace of the new builds isn't slowing down because of some perceived supply deficit. And the reason for that is there has never not been uranium. So the utilities have never come into the market and not been able to get what they wanted to buy. There's been instances where they didn't get the terms they wanted. The Koreans come in every year in Q3 with an RFP, and they do it a little bit differently than most RFPs. Most RFPs are like, we're looking for this amount of uranium to be delivered on this time frame. Give us your terms. The Koreans are like, we need this much uranium delivered on this time frame. Here are our terms. And then they wait for responses or not. Last year, they didn't get any responses. They came in with a big RFP, and 18 months, this was the previous year, actually. This is 2023 Q3. RFP, they came in, these are our terms, didn't get a response. 18 months went by and they didn't get a response. And finally, they had to revise their terms to the terms that the market would digest, and they were filled on that. Now they're discussing off market. That's just how the market has changed. There just isn't the uranium out there, especially not the prices these guys want, to say, here's what we need, and they get a bunch of responses. That market is gone. So if you're a fuel buyer right now, you have to be creative. You're flexing up on your legacy contracts. You're shoring up. You're buying a little bit in the spot market when the price drops. You're doing some carry trades here and there. You're making some deals where you can with the developers because the developers are the only ones that are offering up prices around the printed price, that $80 fixed price. Long term, one developer that has engaged in some contracts, $80 base escalated, they're done. They have no more to offer at that price. And they've been largely influential in keeping the price there. So new demand coming into the term market is 100% going to move the price to the upside. We don't know what fixes this supply problem, Tom, and most of the risks here are right tail. There's always the left tail nuclear accident that absolutely could poorly affect sentiment. If policies change because of an accident, that could actually affect demand. That's worst case, and that's left tail, and that's always looming as a potential possibility. It's always there. Supply surprises would be a left tail disruption. We don't know where that would come from. We were scouring the planet. There's some developments here and there. China is trying to figure out seawater extraction. They still haven't cracked that nut. Eventually 15 years from now, will we have commercial seawater production? Maybe, and hopefully. For now, the right tail risks, more military demand, accelerated SMR demand. The SMR pipeline has doubled in the last 12 months to over 50 gigawatts of global demand in the pipeline for SMRs, 50 gigawatts. And nobody is modeling for SMR demand. Further inventory restocking is a significant right tail. We don't know how much or when the utilities are going to procure above and beyond their burn rates, but it will happen. And then, of course, the disruption from from tech companies. They're building out these data centers at absolute breakneck pace, and we're seeing more and more evidence of direct involvement in the nuclear fuel cycle potentially, and in the nuclear projects. The venture capital arm of NVIDIA yesterday just invested $650 million into TerraPower. TerraPower is building the Natrium reactor in Wyoming. So it's all, I mean, some days I just have to kind of pinch myself at the developments I'm reading. It's truly, truly remarkable how supported nuclear is right now and how fast it's growing. We model based on what's under construction right now and what's currently operating a 3.1% compound annual growth rate. If that accelerates to meet the demands of the COP 28 and 29 goals of tripling nuclear by 2050, that's almost a 5% annual growth rate. If new builds accelerate, which as of now, we're looking at about a 3% compound annual between now and 2035. And that demand is basically baked in. We know what's under construction. We know what's operating. We largely know what will be shut down or life extended. Most of those ifs in terms of life extensions are likely to be extended rather than shut down. So it's all coming together as far as we can see.
Well, I mean, again, the fundamentals of the market are what they are, and that picture doesn't necessarily change. There's going to be, ups and downs through that, but at the end of the day, that equation is what it is, especially going into that next decade. And I always appreciate you filling us in on all of these developments, Justin. Is there anything that you'd like to leave our listeners with to think about?
I would just say that the sector right now is short-term overbought, and everybody was waiting for the sector to sell off and at least come back down to a higher low and consolidate the recent move. And now Sprott is in there about to buy Uranium. So will this be a flash in the pan? If so, if Sprott comes in heavy and the price jumps, and over the next 2 or 3 weeks, we have a big blow off top, any consolidation after that is going to be a buyable dip because we have yet to see the utility demand really come in. So if that's anything that if anything I can leave your audience with is this is going to be a sustained bull market for the commodity. There will be wild, violent swings up and down. And you have to look at the physical market and keep tabs on that as much as you possibly can. That is the most important thing, because seeing what was happening in the physical market is what gave us conviction and continues to give us conviction when the market gives you volatility to the downside. So I'll give you one last example and leave you with this, why this is so important. The spot traded pounds and the carry trade volume that we saw March and April, we saw that in February to some extent. We saw that dynamic shift before we saw the equities bottom. So late March is when we started to see the price of uranium continued to kind of stagnate on the low. 63, 64, I think, was about the low point in the first week of April. But even before that low point, we started to see the dynamic shift. The motivated selling that was in the market from December till about February, even into early March, that slowed down. At the same time, utilities started to step back into the spot market. They were buying in spot. They were engaging in more carry trades. And that dynamic shifted as the equities bottomed. And because we were able to see that, we knew that that was a moment to not to be capitulating into, hang on through, if not put money to work. And you have to see the physical market dynamics, and seeing our modeling gives us enormous conviction. So we're going to see higher highs, higher lows, crazy swings in sentiment. That's going to continue. And we think we have a multiple year runway, a very, very tradable market. So just know that when the market gives you opportunities, when you see RSI freaking 18, like we did in April for some of these equities, know that we are still in a structural bull market for the commodity. And that's a gift. Everybody wants to buy low and sell high. To quote Lobo Tigre, our mutual friend, you can't skip the buy low part. So if you're all in and the market is soaring, give yourself some cash, because there's going to be another opportunity to put it to work. Until the supply deficit is solved, dips are going to be buyable. That's kind of the big takeaway here.
Mm-hmm. I think that's a perfect way to summarize it and to look at it, Justin. Of course, for anybody interested, all of your stuff, your newsletter, and of course, your other paid services available at uraniuminsider.com, and of course, at Uranium Insider on Twitter as well. Justin, thanks so much for your time today. I always appreciate getting to catch back up with you.
Same. Always a pleasure, Tom. Thanks for your time as well.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.